Hello, I've just got back from my first day at a new job, so I am absolutely knackered, but I wanted to share with you the market's down 2.4%, which is absolutely huge. And when I first started investing, I really didn't understand what these swings were. If the overall market's down 2.4%, I'm sure some of the smaller cap or more speculative stocks are down massively. So I just wanted to do a short video to explain what's happening and explain whether you should be concerned for the long run or whether this is just a dip and a buying opportunity. So the reason why the market's down so much is because the Treasury Secretary Janet Yellen has suggested it may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat, even though the additional spending is relatively small relative to the size of the economy. So what does this comment mean? Well, interest rates are essentially raised when the Treasury is concerned about inflation. So to prevent inflation, the costs of consumer goods going up too quickly, they increase interest rates. Now, why does this impact stocks? Well, if you're a big hedge fund manager and you know that the stock market goes up on average 7% a year and you can borrow money at 1 or 2%, then it makes great sense to be borrowing loads of money. And if you look at the margin statistics, you can see that we are, well, first let me explain what margin statistics are. This is money that institutions are borrowing to put into the stock market or into other assets. So we can see that if we look back at 2020, for example, we started out at 561 billion, this is billions. We're now at 822, and actually that's a record amount of borrowing. So huge borrowing to put into stocks. If interest rates go up and you're borrowing, they may even be borrowing, 2 to 3, 4, 5 times what they have in cash. That makes sense when interest rates are really low and you're going to gain a lot of money on that return. But there is a risk associated with that, a big risk. And if interest rates go up, that risk-reward balance becomes a lot shiftier. And so you may be looking at, okay, well, maybe I'll get 3% return, but I'll be borrowing at 3%. Do I really want to be taking that risk? Shall I bring down my margins? So that's why a lot of people are selling out of stocks at the moment, particularly the small cap stocks that they see as more speculative, and perhaps they've put some of their margin money into those speculative stocks. They'll be pulling out and bringing down this margin position. This will happen as interest rates rise, but generally solid stocks are quite inflation and interest rate proof. So you may see a dip temporarily, but putting your money into fundamentally good stocks, and it's important that you check the fundamentals, will last, particularly if you're long-term investing. So very quick video, that's all I wanted to say on the subject. Hopefully that cleared up for some people. If it did, please like and subscribe. I really have a tiny number of subscribers, so any clicks will greatly help out the channel and I can provide more updates. Thank you for your time.